My name is Josh Spurrell, and I'm the president and founder of Spurrell & Associates Chartered Professional Accountants. The four main sections of an income statement is the gross revenue, the direct cost of sales or delivering those products and services, the general expenses of the business, and then other income or expenses that are not specifically tied to the operation of the business. It's a good idea to organize your income statement in numerically descending order so you can focus at things at the top of the income statement that are significant line items and that are substantially affecting your net income, rather than spend your time in the weeds on insignificant line items. It's a good idea to limit your income statement to one page. This should be a document that you can look at quickly and efficiently make decisions to maximize your chance for success in business. It's difficult to compare performance from one period to the next, therefore from 1 year to the next or from 1 month to the next, if you have too many accounts in your business. What will happen is you'll tend to classify things in different accounts over time. Therefore, when you're comparing one period to a prior period, it might not have been classified the same, and your analysis of if you're performing better or worse might be off. Rather than add account after account to your chart of accounts, if you do need more detail, you can add sub-accounts that can be wound up into a general account. Also, you can use items that are built into bookkeeping software like QuickBooks that can be used to filter your expenses rather than cluttering your chart of accounts with another account. The fewer revenue accounts that you have, the easier it is to develop projections based on historical performance. We generally recommend having no more than 3 master revenue accounts that all of your revenue items will wind up into. The direct cost of sales section should include expenses that are generally variable dependent on how much your revenue increases or decreases. For example, if your revenue goes up, generally you'll need more staff to directly deliver that product or service. If your revenue goes down, you might need more supplies that were directly required to deliver that product or service. In most businesses, the most significant general expenses are things like rent, your office and administrative staff, as well as the depreciation on your equipment or buildings that are required to run your business. Generally, you do not want to put the salaries to the business owners or their families in direct cost of sales or general expenses. What this allows you to do is to get down to one number, which is how much the business makes before the owners of the business get paid. Your other income and expense category generally exists below income from operations. So these are items that aren't tied directly to the business specifically. For example, these are the salaries that are paid to the business owners, the income taxes paid, or profits from the sales of assets or investments that aren't specifically tied to your business. We generally recommend to business owners that they focus on income from operations because this excludes the items that don't necessarily deal specifically with the operation of their business. For example, it excludes wages paid to the owners or taxes paid.